So, hi, it's Monday, 18th of March 2019. This is Real-Time Daily Trading Ideas. We have 5 days a week, 5 different traders. We will speak about trading ideas, strategies, market screening, and maybe 1 or 2 questions from your side directly answered in our webinar. Our goal is quick and smart, so let's have a nice start, like every day. And like every day, we will start with our risk disclaimer. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. If you are a starter, please start with a demo account and make yourself familiar with long trading, short trading, leverage trading, and your personal risk management. If you'd like to read the full disclaimer, just visit one of our web pages, for example, admirmarkets.com, and you will find the long version of the risk disclaimer there. Also some other information, for example, the different offers and options for retail clients and professional clients, everything to find on our web pages. This is our scheme. On Monday, like today, it's Jay's Day. On Tuesday, it's Paul's Day. On Wednesday, it's Giancarlo's Day. Thursday, it's Marco's Day. And on Friday, it's Dick's Day, our leading day traders live every business day, every trading day to the same time. And of course, if you like to trade Forex and CFDs, you will get many benefits only with us. For example, DAX 30 to a spread of just 0.8 points. And since 2 weeks, also possible with just 0.2 points average spread if you choose our Admir Prime active trader account plus the commission. So check it out on admirmarkets.com for DAX traders. More information there. And for Forex trader, one example, euro dollar, 0.6 pips, triple spread without additional commission. And if you'd like to see what we are doing globally, we have offices in the European Union, we have an office in Chile, and of course we have also an office in Australia. Check it out on admirmarkets.com. And now it's time for Jay. Good morning, good day, Jay. What's your view to the markets today?
Good morning. Good morning to you, Jens. Can you hear me?
Yes.
Okay, excellent, great. Good morning, traders. I hope you all had a very good weekend. We spent a couple of days in Zurich trading traders. It was quite interesting. All right, risk disclaimers in full effect. Let's dig into the new week. We have a busy week with 3 different central banks. As always, we look at last week's trade first. And as we can see, we just got triggered into a short Aussie New Zealand, which was the idea from last week. But only just now we got put into the position, which is completely fine because the fundamental reasons on which I base the trade are still in full effect for me, and hence I am happy to have the position short. Here we go. That is currently what it looks like. So it took us quite some time to get up there to trigger the more attractive short, in my opinion. We'll see. Headlines, quite a bit of headlines. We had Asian equities mostly green. We saw that the Australian index was up by 30 basis points. Commodity names were performing nicely there, but the financial sector was a bit weaker. We had the Nikkei obviously with strength. We also saw the yen weaker overnight. And we had headline trade numbers coming in better than expected. But once you look into the quality of the data, you will see that export and imports contracted both more than expected. So the data wasn't that great. What we usually tend to see is a reaction based on the headline data. And then once analysts have time to look into the data, you see the counter reaction once again. Hang Seng and Shanghai were positive, although we had a negative headline. Wasn't it only as recent as February that Trump tweeted, very, very soon we'll have a tremendous deal, a great deal coming, the stock market's going through the roof, whatever. We're now talking about June, if there is a summit happening at all. No final agreement definitely by April, and what we're hearing is that within the White House, parties are separated and there's a big divergence about this trade deal. The PBOC did pump liquidity into the market, so we are seeing Chinese equities long, and that is a trend long. If you're ballsy enough to trade that market and get involved there, Chinese equities, of course, centrally planned, are a long trend currently. She, though, is to visit Europe this week. And they're going to bolster the trade relationships and very concrete targets. They want to, until the summer, come up with a list of what's hindering trade and want to commit to reduce these hindrances by 2020. That's actually quite positive for Europe, because you have to understand that if the US and China agree on a trade deal, whatever they agree on, that's business that's not coming to Europe. Okay, so it's actually quite positive for the Europeans that the Chinese are coming over to open that front up, and that's quite negative for Trump, actually, who is in a lot of trouble. Deutsche Bank was just ordered and subpoenaed some documents regarding business dealings of Trump in the past, from the past. So there's some crap brewing on the horizon. But the market is not focusing on that. The market is able to focus on 1 to 2 things only. And one of the things is the trade war, which is seeing no resolution. So the market will stop caring for that, about that for this week at least. And the focus shifts to Brexit, where the Prime Minister was heard to be putting the deal in front of the Parliament, House of Commons for a 3rd time. Amazing. So the pound is too strong right now. There's no need in buying it. The economic numbers expected for this week are good. I would like to buy the pound, but not here at top edges. That's absolutely useless, at least for me. If you are a breakout trader, good luck with that long term in your career. But if you are, maybe that is an opportunity that you see here. I don't. If, however, it retraces, I may be interested in a long, potentially versus the Swiss franc or versus the Japanese yen. So if, however, May does not get enough votes and support for her Brexit deal, which she hasn't gotten twice, so why put it in front of the people for a 3rd time? But anyhow, they may pull this for this week. They may pull the 3rd vote. Wow, that's smart. The DUP, however, now was reported that they want a seat at the negotiating table with the EU. Remember, it's all about this darn backstop deal with Ireland, Northern Ireland. So, in return for supporting the Prime Minister. Then, Labour's chief Corbyn signaled that his party and they would back an amendment aimed at securing a 2nd referendum, Brexit referendum. This is in fact what I personally have been expecting ever since the first referendum came out. I don't really see them exiting. And what we're definitely seeing is that we're using the well-proven strategy of Europe, where we simply vote and vote and vote until Brussels and whoever else is in charge really gets the outcome that they desire. Interestingly enough, the Europeans overnight stated, or over the weekend, that an Article 50 can be extended multiple times. There's nothing in the text that forbids that. But there's a caveat here: if the UK has not held EU elections by May 23rd, recall that EU elections are coming up, then they will not be able to extend beyond July 1. And that's also not in the interest of the hardcore Brexiteers, because that would mean that we're looking at an extension of 21 months and not 3 months, 21 months. And me personally, I have to ask the question, what's going to be different if we extend until for another 3 months versus now? Are they really going to get their crap together and come up with a better solution? I don't know, but again, this week we will continue this saga. The British Chamber of Commerce actually cut their 2019 growth forecast and 2020 growth forecast here from 1.3 to 1.2 and 1.5 to 1.3. And they're seeing business investment at a decade low, only 1% year on year, due to, hello, Brexit. So the uncertainty for the market, and the uncertainty especially for the real economy, i.e. real businesses, is really, really hurting the economy, starting to hurt the economy, and it's starting to hurt the business field over there. Forex overnight was quite quiet. Why? Because we have the FOMC and potentially, well, not potentially, and the Bank of England on the docket for this week. Recent econ data out of the US had been a bit weaker, especially industrial production. That kind of sucked. We saw treasuries rally last week on the bad data number coming in for industrial production. Nevertheless, for Wednesday, we are expecting a dovish Fed, and that caused the Dixie, the data and the expectation of a dovish Fed that's getting priced in early, caused the Dixie, that is the dollar index, at least for the Western world, to come off a little bit, which in turn funny enough, saw the Aussie dollar trade above 71. Still, I see the New Zealand dollar appreciating at a faster rate, and hence the short Aussie New Zealand makes sense. That's the trade I'm in currently. Oil hit 59 last week. Congratulations to one of our traders who sent me a great email. It was his first trade. He was one of the recent graduates from our seminar program, and it was his first trade where he put all our puzzle pieces in a row, expected 59 to hold, the market to turn around. His risk was 1%. He made 2.5% in one day. He was quite happy. Congratulations to you. He's a pilot for now. Maybe one day he'll be a full-time trader. He's actually, he now gets it. He understands all the different puzzle pieces. Commentary out of OPEC, quite a lot of comments this morning. This week we get new information from OPEC and non-OPEC, the monitoring committee, regarding the supply cuts, and just fresh off the headline ticker, OPEC Plus said to be planning next JMMC meeting in Riyadh during May. So the Russians weren't that keen on committing to another extension of the supply cuts. Saudi Arabia is over committing to their over delivering on their commitment to cut supplies. Oil market is waiting a little bit on new information regarding this situation. We had interesting reports and research pieces last week regarding the oil demand for this year and oil supply for this year. If you're an oil trader, I invite you to read these reports. They're very, very important for us. Overnight, we had Dalian iron ore. It's a very important indicator for Aussie dollar, rising on supply concerns. Recall that we had a catastrophe last year on Vale, which is one of the most important miners when it comes to Dalian iron ore, and they had this dam that broke in Brazil. So Brazil ordered Vale to halt another mine, and the company just suggested that they're seeing a 12 million decline in annual output due to dam suspensions. And that naturally causes upward price pressure for Dalian iron ore. Then in Germany, we have this unbelievably fantastic, I'm being sarcastic, bank merger between Deutsche Bank and Commerzbank. The government approved this merger talk. The board of Deutsche last week approved it. Although labor unions are going crazy, and recall we're living in a socialist country over here, 30,000 jobs going down the bin. Government says, well, we don't care. It's going to have to happen. So interestingly enough, the equity investors are liking it. We're seeing Deutsche Bank stock up 3.1 on the back of this in the open this morning, and Commerzbank up 3.5%. What I found interesting is that Allianz is looking at merging their asset management arm. Recall Allianz owns PIMCO, and Allianz also has their own asset manager called Allianz Global Investors, and they're looking to potentially buy DWS, which is the asset management arm of Deutsche Bank. DWS stock on the back of it up 4.5%. That actually does make sense, in my personal humble opinion. PBOC officials on the ticker this morning stating that local government hidden debt, bond defaults, and a property market bubble could trigger financial risks. No shit, Sherlock. The stability of the renminbi and the forex reserves face pressures. Naturally so. Watch the dollar renminbi chart and the 625. Maybe that comes in play again. So the range is 7 down to 625. I know it's a huge, gigantic range, but it is of importance, especially when it comes to the trade war between the US and China. This is the picture this morning when we hit the desk. Overnight session, as you can see on the lower left-hand side, Aussie dollar up, New Zealand dollar up, Canadian dollar up. What was down? The pound, the yen, and the US dollar. So pretty much a risk-on scenario. Interestingly enough, we saw some Asian bourses close in the red. Philippines, for example, Thailand still red. So do not think just because the centrally planned bull market in the Chinese equity markets has anything to do with real economic growth in the region. It doesn't. And as that's very smart PBOC official recently this morning just stated, We have a lot of issues regarding credit and bad debt in the background in China. We will never know the truth, though, because it is centrally planned. All right, carry on. What do we have going on over in the US? It's all about the dollar king. On Wednesday, we have the FOMC rate decision. Of course, it's expected to remain unchanged at 2.25 to 2.5. And quite important, the economic growth forecasts and what they call the dot plots are expected to be guided lower. The Fed communicated last time 2 rate hikes for this year. That's 2019 to 2.75 to 3%, and 1 more rate hike in 2020 to 3 to 3.25. Now, let's see what the market is pricing in. Billions of dollars getting bet on right now, and what the market is pricing up. They communicated a neutral rate of 2.75 to 3. The market this morning is pricing in a 74% chance for no rate changes whatsoever for this year. I just checked this year. 23% chance for 1 cut, 3% chance for 2 cuts, and there's one guy, who knows who or what or whoever, there is a not 2% probability being priced in. There's a bet going on right now in the market for 3 cuts. So that's quite an interesting here. As you will see that probability rise of more rate cuts, 1 or more, that's additive, obviously, you will see the dollar under pressure. One major focus for the market will be what, dear Fed, will be your terminal size of your balance sheet. JP Morgan estimates that it peaked around 4.5 trillion. Yes, that's trillion dollars, and is now roughly around 4. That's a little high, actually. I have a more concrete number coming up. And the pace of the normalization is currently capped at $50 billion per month. The base case for the market is that this normalization concludes by the end of this year, and the balance sheet would come in anywhere at around 3.5 to 3.6 trillion. So very, very, very much larger, bigger, far away from what we had prior to the global financial crisis in 2008. And excess reserves would then stand at around 1.1 to 1.25 trillion. Excess reserves is quite interesting and quite an important driver in the market in the background. Goes beyond this morning webinar, though, to explain what that is. Last week's Fed's portfolio of securities outright held at 3.786 trillion. So we had no reduction last week in the outright holdings. So it's not 4 trillion, it's 3.786 trillion. And treasuries accounted for just under 58% of the entire portfolio. And that's unchanged from 6 weeks ago. This is important to the mortgage market because the Fed bought quite a bit of mortgages. And very different from, for example, Germany, where not many people own their own homes. In the US, you have home ownership is quite a lot higher. So mortgage rates are important there. Has something to do with what's called also the wealth effect. If the refinancing of your mortgage increases, that's going to dampen consumer sentiment, basically, in a nutshell. And what's happening is that the Fed would like to change the composition of their balance sheet away from mortgages again, more towards just simply treasuries. And then the buyer, not only of last resort, but the largest artificial buyer who is not price sensitive in the mortgage market, i.e. the Fed, would then drop out of the mortgage market or be reduced in terms of size. And that, of course, would mean that yields could go higher as prices would go lower, and that again would dampen consumer sentiment. So since the commencement of quantitative tightening on October 1st, 2017, the total balance sheet assets are now down by 10.9%, or simply annualized pace of 7.6% decline per year. It would take us many years to bring the balance sheet down. But as we learned, nobody cares really, because for some reason or other, there is no inflation. And that actually has to do with the Amazon effect. You can Google that if that is of interest to you. Friday, we have market flash services PMI. Services PMI is much more important than manufacturing because in the US, manufacturing only makes up 15% of GDP. And services PMI is healthy at 56.6. higher than last time, expected 56.6. And last month, you may recall that it was reported that input cost inflation accelerated from the near 2-year low seen at the start of 2019. Please somehow try to remember this for the trade idea that comes at the end of today's webinar. Input cost inflation is accelerating. Higher operating expenses and improving demand conditions contributed to another solid increase in average prices charged by service sector firms. But what we saw last week is that average earnings are ticking higher. Or was it 2 weeks ago? I forgot. So that means if global growth comes off and companies are generating less revenue, but their average hourly earnings are increasing, i.e. their labor cost, then you have a situation that's called margin pressure. So I would be very careful and differentiate carefully which type of equity you buy in the US. I'm neutral on the S&P, I'm bullish on the NASDAQ, and I'm bearish on the Russell, for example. That's just my 2 cents. What do we have going on in the UK? Thursday, we have the Bank of England with their official bank rate, and that's expected to remain unchanged at 0.75%, with a split vote of 9-0, i.e. everyone on the committee is expected to vote for leaving the rates unchanged. Recent economic data was good, although house prices in London this morning were reported to continue to come off. Why? Due to Brexit. Yeah. It's also quite interesting if you look at the composition of the GDP in the UK, you will see that the financial services sector is making up the largest percentage of GDP, and of course that is located and centralized in London. And if Brexit causes some havoc there, then that is the natural and logical explanation why housing prices are coming off. Overpaid bankers can't afford the prices if they lose their jobs. January GDP data came in at 0.5% month-on-month versus 20 basis points expected, so that was solid. Overall, the UK economy, we have to admit and state and clearly see, is holding up quite well despite the Brexit saga. Services PMI for March actually came in unexpectedly high at 51.3. The market expected the number to contract down to 49.9. And please recall, anything in terms of PMIs above 50 is expansionary and below 50 is contractionary. The Bank of England is sitting on their hands until the Brexit fog clears. There's not much they can do. On Tuesday, though, we have jobs data, and it's expected to signal continued tightening in the labor market. The unemployment rate is expected to remain at 4%, and the claimant count, which is the leading indicator for the economy, is actually expected to come off down to 13.1 thousand versus 14.2 last time. Average earnings are expected to tick a tick lower to 3.2 versus 3.4. But nevertheless, please don't underestimate the trend that average earnings are actually increasing. And that's why I included this chart for you guys here. As you can see, since the end of 2018, we are seeing inflationary pressures when it comes to average earnings. Second slide, Wednesday, we have the very important inflation number, CPI, and inflation is expected to remain at 1.3 versus last time, at 1.8, excuse me. The Bank of England informed the markets during the last QIR that the UK will experience a period of below target inflation with, quote, the next significant move in inflation is only likely to come in April when the off-term price cap is lifted. What is that? Also quite socialistic, that country. The energy providers for retail clients have a pricing cap. And so if they have seen increased costs of input for heating oil, for example, or natural gas, they could not pass that on endlessly to the consumer. That's a price cap. And this price cap is coming off in April. And since input costs did increase naturally, we will see an inflationary component being added back into this number. Higher inflation means eventually, if inflation were to be way beyond the Bank of England's target, would mean the BOE has to hike rates, would mean the pound would see strength. Again, pound would be super positive, definitely along if the Brexit fog would have been cleared by now. Thursday, retail sales coming in, or the expectation is for it to contract by 40 basis points versus an expansion of last time, growth of 1%. So we have that on the radar. It's quite hectic, though. There's a lot of seasonal factors going into that number on a month-by-month basis. Last but not least, because I'm not going to go through everything with you guys in the interest of time, we have the Aussie dollar and the RBA. We have RBA minutes. Yes. But what I wanted to point out is the employment change on Thursday. Expected to come in at 15.2 thousand versus 39.1, and that may cause the unemployment rate actually to hike up to 5.1. I know when you look at your calendars on the net right now or from your broker, it will read 5.0 as expectation for the unemployment rate, but it could actually tick higher. So do not be too surprised because you heard it here now. The problem is that the RBA has quite an optimistic outlook when it comes to the labor market. And a labor market situation is very, very important due to the massive housing bubble in Australia. The housing bubble in Australia is roughly 4 times larger than it was in 2008 in the US. So there's a great opportunity if you're looking to buy a property there in the next 2 to 3 to 4 years, whenever that bubble bursts, get some cash ready, fly over, buy yourself a nice property in Australia, because that's going to come to fruition, that trade. I'm actually seriously thinking about doing that. The recent ANZ job adverts data, it's a leading indicator for the labor market, recently hinted that the employment growth could ease to a pace below 2% on a year-by-year basis versus 2.2, which we saw reported in January. So keep an eye on the labor market, because the RBA will as well. And recall, I'm short Aussie dollar. Now, if I get stopped out of the position, I don't care. It's just one trade. I would short the Aussie again, because fundamentally, I expect the worsening of the economic scenario in Australia to fully play out in the next weeks. Possible trade opportunity for this week. So recall, inflation is rising, not significantly, but we're seeing it rise, but growth is not rising. So that means real yields are coming off, and that means I'm looking to long gold. I wanted to give you a commodity trade and myself, because we're already in that short Aussie New Zealand. All right. So on Wednesday, we have the Fed. We're expecting them to be dovish, and we are expecting the inflationary pressures to continue to expand slightly in the US. That means real yields are coming off further, and that's very bullish for gold. What is the risk to the trade? That would be a massive risk on sentiment. Yeah. Gold naturally rises when there's a risk-off sentiment. Gold has difficulties rising, or would naturally tend to fall rather if we have a massive risk-on sentiment, and or a less dovish Fed, i.e., we are linked severely to the US dollar. Is the dollar rising? This trade would probably get stopped out. If the dollar continues to come off, which it started doing last week as they're pricing in this dovish Fed on Wednesday, then the trade has a solid chance to reach the profit target. Here is the trade structure. As you can see, market makers are already making the long quite expensive. So long is the correct position for now. Hopefully we'll get somewhat of a pullback. Maybe in New York later on, we'll have to see, down to 1302.6. Take profit is 1311.25, and the stop loss is 1298.275, which yields us a risk-reward ratio of 2.0. And we'll see. Next week, we might have 2 outcomes from 2 trades. Thank you guys for your attendance. We appreciate you coming in on a Monday morning. I wish you a very volatile week, because volatility we like as traders. That means we can make money, and hopefully we'll see you again next week. Thank you for your time, and hopefully you're learning a little bit. Earn while you learn. That is our intention. Jens, thanks to you as well. Back to you, sir. And thanks to my traders.
Thank you
as well. Bye-bye.
Jay, 5 days a week, 5 different trading styles. So if you like more chart analysis, join us tomorrow. Tomorrow it's Paul's day. So 5 days a week, 5 different traders. And if you like Jay, a couple of hours later, it will be available in our YouTube channel in the English one. So go to youtube.com/AdmirMarketsFX. Thank you. Great start in the week. Greetings from Berlin office. Bye-bye.